Welcome to StaalX Construction and Steel Podcast. Episode 7, Cautious Optimism in Construction Emerges, Fed Policy and Steel Momentum. Before we start, a quick shout out to StaalX, the smarter way to source steel. Whether you're buying rebar, wire rods, or mesh, you can now get instant pricing, make an offer directly online, and track your orders, all in one place. Check out our new walkthrough video, How to Use StaalX, and see how easy it is to get started at StaalX.com.
Welcome back to the deep dive. For what feels like ages, maybe the last 2 years or so, the word around construction has just been, stagnation, hasn't it?
Yeah, pretty much.
Yeah.
Developers holding back, money getting tight, confidence just wasn't really there.
But the sources we're looking at today, they're suggesting something's shifting. It's subtle, maybe, but it seems like there's this quiet sort of strategic optimism starting to bubble up, looking towards 2026 specifically.
That's right.
So we're going to try and pinpoint what exactly flipped the switch, what moved the mood from just waiting around to actually planning again, especially when you look at materials like steel.
Absolutely. And the sources we've got, they're mainly looking at two things: how the market's reacting to what the Federal Reserve's been doing lately with rates, and also this really detailed StaalX report.
StaalX, the steel data, folks.
Yeah, the analytics firm tracking shipments. They get into the nitty-gritty of steel consumption. So the big question we're trying to answer for you is, basically, are things finally loosening up on the money side? And how's the materials market, especially steel, seeing all this?
And I think the main takeaway, let's just put it out there right away, is that contractors, they're feeling things start to move again, some early momentum.
Definitely.
And it's not just wishful thinking, right? It seems tied directly to policy decisions. The teams that were stuck in that wait-and-see rut, they're actually getting ready now.
It's like hearing thunder versus actually seeing the storm clouds forming. It feels more real now.
Okay, so let's focus on that policy trigger. Everyone seems to be pointing to the Federal Reserve cutting its benchmark interest rate, again, another 25 basis points just recently.
Right.
And just a quick reminder for everyone, a basis point is tiny, 0.01%. But these small moves, they signal direction, yeah. And this one came after another cut they did back in September 2025.
And what's really interesting, I think, is how the feeling, the sentiment changed between those two cuts. After that first one in September, most people in the industry kind of shrugged it off, like, okay, nice gesture of psychological boost, they called it. But it didn't really change the actual cost of borrowing enough to suddenly greenlight huge projects that were on hold.
Yeah, I remember that. We've seen that before, haven't we? Those first cuts sometimes feel like false starts. So what's different this time? Why is the second cut making confidence stick in a way the first one didn't seem to?
I think it really just established a pattern. This latest cut, it sort of cemented the idea that, okay, this isn't just a one-off tweak. It's likely the real start of a downward trend.
Okay.
We actually have a quote here from Robert Brown. He's the CEO at GCM Contracting Solutions. He said, "Since the first cut in September, we have seen a slow but steady return of confidence." See? Slow, steady return. It wasn't about one big price drop. It was about seeing consistent movement, predictability.
And that predictability, that's what lets developers finally say go. The ones who've just been sitting there maybe with a lot of capital tied up.
A huge amount, yeah.
They're now actually calling their teams back. They're looking at early 2026, thinking financing will be looser then, and they realize, okay, we need to get the planning, the permits, the design work going now if we want to hit that window.
The whole wait-and-see thing seems to be wrapping up. But you mentioned something critical earlier. Robert Brown's point. It wasn't just about the interest rate number itself.
Right.
The real kicker isn't just the cost of borrowing. It's the certainty.
Okay, explain that. Why is certainty more important than the actual rate difference right now?
Well, think about how long these construction projects take. Years, often. So if you're an owner, seeing these rate cuts happen one after the other signals the start of a sustained easing cycle. That's the key phrase.
Got it.
If you're about to commit, maybe billions, to a project over 2-3 years, just knowing the direction financing is heading, that rates are likely coming down, not suddenly spiking again, that knowledge, that certainty, is almost more valuable than whether today's rate is 7% or 6.75%. It lets you commit, even while you're still being careful with the budget.
That makes a lot of sense. It explains why we're seeing actual activity now, not just hopeful talk. So which projects are moving first? The sources say it's the ones that were like right on the edge already.
Exactly. The ones that were maybe 90% ready to go, design mostly done, financing lined up, they just needed that final clear signal.
Okay.
But even with this returning confidence, it's not like the floodgates are wide open with no caution. People are still focused on managing risk. We're seeing this continued move towards design-build contracts.
Right, design build. For anyone not familiar, why is that model so popular for risk mitigation right now, even as things look up?
Well, in the traditional way, you have separate design and construction contracts,
Yeah.
right? And the owner can get hit with unexpected cost increases during construction. Design build puts it all under one roof, one contract. It helps lock in costs, especially for materials and labor schedules, much earlier in the process. Basically, it shifts some of that uncertainty away from the owner, and that's exactly what clients want. Right now, they're feeling more optimistic, but still disciplined.
Okay, so we've got the Fed providing that certainty catalyst. Now, what about the underlying demand? That's got to be there too, right? To give this optimism legs into 2026.
Absolutely. It's not just about the money. The actual need for building is strong.
Yeah.
You look at the big materials producers, Vulcan Materials, Eagle Materials, Martin Marietta, they're all still reporting really solid demand in non-residential construction and infrastructure work.
That's the bedrock then.
Pretty much. A lot of that stability is coming from the public sector money, specifically the Infrastructure Investment and Jobs Act, the IIJA. This isn't just projected spending, it's money already allocated and working its way through the system.
And the number that always jumps out at me is that only, about 40% of those IIJA funds have actually been spent.
Exactly. That means there's still 60% of that huge funding package waiting to hit projects. That visibility, knowing that spending is coming down the pipeline, stretches well into 2026 and beyond. It gives a whole industry, especially material suppliers, a solid foundation that isn't easily shaken by short-term economic bumps.
Right. It lets them plan. Okay, so with that foundation in place, let's get into the specifics driving materials demand right now. You mentioned the AI economy.
Yeah, this is where that StaalX report gets really interesting. There's this massive boom in data center construction, huge projects, plus chip manufacturing plants, other big institutional work. And this specific demand surge is so strong, it's actually making up for weaker areas, like, say, traditional home building.
Right.
It's creating this really intense, though maybe localized, need for certain materials.
And Vulcan CEO Tom Hill, he basically confirmed this, right? He said something like, data center work is stronger than expected, and we're not seeing project delays anymore.
That last part is key. Not seeing project delays anymore. Think about what we were hearing just 6 months ago. Delays were common. This signals real urgency now.
Okay, urgency. How's that playing out in the steel market? You mentioned long product.
Yeah, things like structural steel, rebar, wire rod. That segment is seeing demand that's much better than you'd normally expect for Q4. Usually things slow down a bit towards the end of the year, weather, holidays.
Right.
But the speed of these current projects, especially the data centers, is just pushing right through that typical seasonal dip.
Okay, now this leads to something kind of weird in the steel market, doesn't it? The StaalX report mentioned this. Paradox. Mills aren't really jacking up prices despite the strong demand.
It's fascinating, yeah. The report calls it unusual discipline from the domestic mills, especially on rebar. Demand is clearly strong, maybe even outstripping immediate supply in some cases, but they're holding the line on their official price increases.
Why? Why leave money on the table like that? It seems counterintuitive.
It looks like a very strategic play. They are charging more if you're a new customer, someone coming in looking for spot tonnage outside of their regular allocations. Those prices are definitely higher.
Okay, so a two-tiered system.
Kind of. But for their big regular customers, the official price sheet isn't jumping dramatically. And the thinking seems to be about the long game, protecting against risk, and crucially, imports.
Ah, imports. Explain that connection.
Well, first, maybe they don't want to look overly greedy, right?
Yeah.
They've had price hikes before linked to tariffs and other things. Maybe some of their own costs, like scrap, have eased a bit. But the really big driver seems to be keeping imports out.
How does keeping their own prices steady do that?
By keeping the price difference, the spread between domestic steel and imported steel relatively small. If domestic prices shot way up, it would give buyers a really strong incentive to look overseas for cheaper options. By holding prices somewhat steady, even with strong demand, they reduce that temptation.
So they're sacrificing maybe the peak profit right now
Potentially, yeah.
to protect their long-term market share from foreign competition.
Exactly. It's a defensive strategy. And they probably feel they need it because, according to StaalX, domestic mills just can't produce enough right now to meet this sudden surge in demand. Inventories of rebar are getting drawn down really fast.
So there's an actual inventory crunch happening.
Looks like it. Master distributors are apparently sitting on pretty low stocks. That's pushing up the spot prices for immediate truckload deliveries. Even with imports coming in, they're just not filling the gap fast enough because these data center projects are consuming materials so quickly.
Wow. The speed of that AI economy build-out really caught the supply chain a bit flat-footed, huh?
Seems that way, especially for structural steel and rebar.
Okay, but we need to draw a contrast here because steel isn't all one market, right? What about flat-rolled steel, the stuff used more in cars, appliances, that kind of thing?
Yeah, totally different story there. While rebar is tight, flat-rolled pricing has actually been falling since about June. Mills have really struggled to get any price increases to stick in that segment.
Why the difference?
Two main reasons, according to the sources. One is just more production capacity online for flat-rolled, but the bigger factor seems to have been inventory buildup. Buyers stocked up heavily earlier, partly trying to get ahead of potential tariff hikes.
So they created their own supply glut.
Pretty much. And that overhang of inventory has kept downward pressure on flat-rolled prices for months now.
So strength in longs, weakness in flats. But even with flat-rolled being weak, is that optimism still showing up somehow? What are buyers thinking now?
Yeah, even there, the mood seems to be turning. The consensus now, almost universally among buyers apparently, is that the flat-rolled market has finally hit bottom. Prices probably can't go much lower without forcing mills to make significant production cuts, which nobody really expects right now.
Okay, so if it's hit bottom, the expectation is prices start to climb back up.
That's the bet. The thinking is, as those excess inventories finally get worked off the stuff people bought months ago and stock levels get back to normal, flat-rolled prices should start moving up pretty soon, probably sometime in Q1 of 2026.
And that expectation, even in the weaker segment, it just feeds back into the bigger story, doesn't it? That the whole materials sector is sort of bracing for a broader recovery next year.
Exactly. It lines up.
Okay, let's try and pull this all together. It feels like we've traced, three main forces shifting the construction outlook? First, those Fed rate cuts delivering that crucial dose of certainty for developers.
Right, the predictability factor.
Second, the IIJA public spending provides that really solid long-term foundation, giving everyone visibility deep into 2026.
The demand baseline, yeah.
And third, you've got this incredibly strong, specific demand driver, the AI economy, data centers, that's pulling materials through the system right now, even defying normal seasonal trends.
Yeah, that's a good summary. And the bottom line from these sources seems to be, look, the market isn't suddenly booming or fully recovered everywhere.
Yeah.
But the key players, they've shifted their mindset. They're moving from just reacting to uncertainty to actually planning and investing for a sustained recovery. The caution's still there, for sure, but the activity is geared towards growth again, not just survival.
Which leaves us with a really interesting question to chew on as we look towards the new year. You explain how the domestic mills are using this price discipline partly to fend off imports, keeping that price gap small.
Right, that careful balancing act.
So what happens to that strategy if flat-rolled prices do bottom out and start rising significantly in Q1? Let's say they jump 15%, 20%. That would suddenly widen that price gap again, wouldn't it?
It absolutely would.
Could that open the door for a new wave of cheaper imports? And would the mills stick to their discipline strategy then? Or would the temptation to raise prices and capture that margin become too strong? It's something to definitely keep an eye on as the market navigates this path into 2026.
Thank you for listening. Explore more at www.staalx.com.